Whoa, we finally, folks, just had a rotation in the market. I've been waiting for this to happen. Because I was starting to get nervous about this. The leverage can't keep going up in the market. Like, people have to pay down their debt. They have to pay down their margin. And if you see leverage continue to go up, you're basically just using debt, funny money, to inflate a big bubble. But take a look at this. FINRA margin, which has exploded to record highs. I was worried we were going to go to $1 trillion soon. It ran up to $882 billion in June. Has finally, for the first time since March of 2020, actually gone down. This is a big deal. In fact, here, this is what 2020 looked like. So you can see right here in January 2020, we had $561 billion. Then we had, once February came around, people started paying down their margin a little bit. You can see that here, February 2020, you actually went down in margin, margin outstanding. So remember, margin is debt on stocks. Then you went down to 479 in March 2020. But look at this. Once we hit the bottom of the market, people literally just kept piling on debt. 524, 552, 584, 613, 654, 645, and so on and so forth. You can see it was literally just straight up to 788, 798. Then we crossed 800 for the first time ever. And now we're all the way up. We were almost at $900 billion in margin debt outstanding, which is absolutely crazy. Now, what's also crazy is that right now we still stand substantially higher with margin debt than where we used to stand. Take a look at this. I mean, 561 was before the pandemic, $561 billion of debt. Now we're sitting at 844. We're substantially higher in the amount of debt we have, but we finally have a flip. Now, I've been tracking this chart for a while, but in fairness, I saw this headline and I didn't even click on it. The first thing I did was go straight to the FINRA statistics. But this is very, very good. The last thing you want to see is debt going up, especially if you're concerned about a bubble. Investors in the U.S. have started to dial back their use of leverage. For the first time since financial markets were rattled by the COVID pandemic, investors borrow, we just saw the numbers here. Separate data from Goldman Sachs, which runs one of the largest prime brokerages in the world, showed that investment banks' hedge fund clients had cut both net and gross leverage in recent weeks. That's awesome. Morgan Stanley has also reported long-short equity hedge funds that trade through it, reducing leverage. We've seen the same thing in crypto. This is really good. Like, this is a perfect, healthy transition for market where you kind of have people hoarding cash. Now, we've seen a little bit of placing of cash during this week, and we wonder how long it can last. But we've got record cash balances at banks. You look at here, Fed, reverse, repo, St. Louis, right here. Let's just look at the record cash balances really quick. Let's see what they stand at now. You've got record cash balances at banks. Investors have record amounts of money, and they're paying off debt. Yeah, look at this. Banks are still at record highs. We're now at 1.1 trillion dollars in reverse repos, the highest we've been at here on Wednesday, 1.147. Banks just have so much cash. That's all this. This is just a line of basically how much extra cash banks have. But anyway, this debt payoff happening at brokers is very healthy. You want this to happen in an economic recovery. All right, let's see here. More comprehensive data from the Federal Reserve on hedge fund leverage not yet available. Interactive Brokers, which serves 1.5 million customers, disclosed last month that margin balances among its clients had declined 2% in July from the month before. Charles Schwab said that margin balances rose by the smallest pace since the retail broker began disclosing them. Good. See this inflection point right here. This is nice. They put it on a nice little chart here. Very, very good. This is healthy for the economy, unless, of course, it's a sign, and people are like, that's it. They see the crash coming and they want to get out of leverage. I'm less inclined to believe that, although I think that has 30% merit. I think it's more 70% is more like, hey, we're kind of at pricey prices right now, and things have been trading somewhat sideways. Maybe let's pay off some debt, which is great. Maybe you also get some profit taking towards the end of the year, but this is great. Okay, the company was all right. This is the same. Large hedge funds kept their stake in Chinese companies. The reduction of borrowing follows a stellar run for U.S. stocks. Well, not for all stocks. The big loss of Archegos, that was a leverage disaster. Fed Reserve warned in May that the tools it and other regulators had to gauge hedge fund language may not be capturing important risks. Yeah, that's always a big problem. Trading activity has been moderated in recent months, and there was a certain level of aggressiveness in trading earlier this year that made people more willing to take on leveraged bets. That's also possible that maybe people are just trading less right now. I mean, right now it's just like we have a herd of animals going from like plot to plot to plot to go buy stocks at various different moments. But anyway, yeah. This is the perfect spot to mention that if you want to get a free stock with Public, make sure to go to metkevin.com/public to download a totally free stock. Public does not buy or sell your information, and the free stock is worth all the way up to $70. All you have to do is go to metkevin.com/public, download the Public app, and if you want, you could even follow me on their social portion, which is I am at MeetKevin on the Public app. It's also a perfect opportunity to mention that you should check out the programs on building your wealth linked down below. 40% off, expiring on Jack's birthday.